Okay, chapter 7 is going to be about standard deduction, itemized deductions, and calculating the income tax. So if we look over the 1040 again, we have your background information, your filing status, your dependents, then your income, and then after you've added up all of your income and calculate your adjusted gross income, then we'll apply your standard deduction or itemized deductions. And then we won't talk about qualified business income deduction today. But then after you've subtracted those, you get your taxable income. And then we figure your tax based on your taxable income. So remember the flow of the tax return. First, you add up all of your income to get your total income. Then you subtract your adjustments to get your adjusted gross income. Then you get to subtract your standard or itemized deductions. And then you also subtract something called your QBID or qualified business income deduction. That brings to your taxable income. And then you figure your tax on taxable income, which if your taxable income is under 100,000, you look it up in the tax table. And if your taxable income is over 100,000, then there's a tax worksheet that you can use to figure out the tax on your taxable income. So here again, we notice the standard deduction for most taxpayers is pre-printed on the Form 1040. And one thing I didn't mention that I should have when we talked about filing requirements, but it was in the book, is that your standard deduction is higher if you are over 65 or blind. And we did mention that your standard deduction is lower if you are someone's dependent. These are the standard deductions for 2023 and 2024 here. Yeah, I don't know if I can zoom in on that. Yeah, there's one column for 2023, one column for 2024. So our 2024 standard, our 2024 standard deduction is $14,600 for a single. Double that, $29,200 if you are married filing jointly. Married filing separately has the same standard deduction as single. Head of household is about halfway in between married filing joint and single at $21,900, and qualifying widow, also known as qualifying surviving spouse, has the same standard deduction as married filing joint. There are a couple of situations where you are not allowed to take the standard deduction. The first one is if you are married filing separate filing status and your spouse itemizes deductions, then you may not take a standard deduction. This is to avoid splitting up, like giving one person all the deductions and letting the other person take the standard deduction. So maybe your mortgage interest is $25,000 and that's your deduction too. If you file jointly, you would prefer to take the standard deduction of $29,200 if we're doing a 2024 return. But you might think, oh, I'm clever. The husband pays all of the mortgage, so we'll just let the husband deduct $25,000, and then we'll let the wife take the standard deduction of $14,600. So altogether, we end up with $34,000 in deductions. That's not how that works, and that's the main reason for this rule here.
Did people used to do that before they said it's not allowed?
I don't know if it was ever allowed. So
makes sense. That's a whole lot of money. They don't want to do that easy, but before the IRS or Congress doesn't want to do that.
And then you're also not allowed to take the standard deduction if you are a non-resident alien. Non-resident alien, in fact, doesn't file 1040. It files a different form called a 1040NR. You might also be a dual status alien, where you're non-resident part of the year, resident for part of the year. And then you would actually have to do a 1040NR for the non-resident part of the year and a separate 1040 for the resident part of the year. But in that case, you can't take the standard deduction on the 1040 on the resident part of the year. Dual status alien, I've only done one of those in my 12 or 13 years doing taxes, so that probably won't come up.
And the end of the year is considered December?
Yes, almost all taxpayers are on a calendar year basis, which is January 1st through December 31st. If you are age 65 or older or blind, you're entitled to a higher standard deduction. And for some reason, if you turn 65 on January 1st, for tax purposes, you're 65 at the end of the previous year. So that's a special rule for January 1st birthdays. I'm not entirely sure whether that actually makes sense or not, but that's just the rule. To be considered blind, your vision has to be as bad as or worse than 20/200, even after correction, or have a reduced field of vision of less than 20 degrees, which is something like that. If you're not totally blind, you have to have a certified statement from an eye doctor or registered optometrist. Okay, so here's your additional standard deduction. This chart is also on page 221 of your book. And the additional amount of the standard deduction depends on whether you're one of the married filing statuses or one of the single type of filing statuses. When I say married filing statuses, I mean married filing jointly, married filing separately, and qualified surviving spouse. And then the other two filing statuses are single type filing statuses. The additional standard deduction for married people is $1,550, and you multiply that by the number of times that you can check one of these boxes. Are you 65 or older? Is your spouse 65 or older? Are you blind? Is your spouse blind? So if both of you are 72 and you're both blind, you get that additional standard deduction 4 times.
Wow.
Of course, with the single type filing statuses, which are single and head of household, you can only check that box up to 2 times. So you could be 65 or older and legally blind, and then you would get the extra $1,950 twice. Now keep in mind the standard deduction is also your filing threshold. We don't count blindness for whether you're required to file a tax return because you don't get to claim the extra standard deduction unless you actually claim it on your tax return. So it's not, you don't get it by default, you have to have some documentation. You don't need any special documentation for being 65. So for purposes of whether you're required to file a tax return, we only look at your age. But for purposes of calculating your standard deduction, we look at age and blindness. So let's, for example, say that we have a taxpayer who is head of household and over 65 but not blind, and we're doing their 2023 return. So for head of household, their standard deduction would be $20,800. And then in the 2023 column, they get an extra $1,850 standard deduction for a total standard deduction of $22,650. Okay, here's our filing requirements chart from way back from chapter 1, and we'll notice that married filing separate at any age, you're required to file a tax return at $5 of income, and that's because you don't necessarily get a standard deduction. So another example, Bob and Mary Smith are both 65 or older and are filing a joint return. So we can figure their standard deduction by taking their basic standard deduction, which was $27,700, and then they get an extra $1,500 for one of them being 65 or older, and another $1,500 for the other one being 65 or older, for a total standard deduction of $30,700. Okay, standard deduction for dependents. If you can be claimed as someone's dependent, your standard deduction is equal to your earned income plus $400. But there's also a minimum and a maximum. In 2023, the minimum is $1,250, and the maximum is whatever your standard deduction would normally be for your filing status, almost always single, which is $13,850. Again, that's earned income plus 400, but then you check to make sure it's inside the range, 1,250, 13,850. If it's outside of that range, then you flip it into that range. When we talk about education credits, we'll find out that we can adjust someone's income, the taxable part of their scholarships, in order to maximize the American Opportunity Credit for whoever's claiming them as a dependent. To do that, we have to treat some of their scholarships as taxable income. For purposes of the standard deduction only, that income is considered earned income, only for the purpose of the standard deduction. So much of the time when we do this, and if we say, we're going to treat your daughter's scholarship, we're going to treat $8,000 of your daughter's scholarship as taxable income, it's fairly frequent that doesn't actually even affect her taxes. She ends up getting the same refund either way. But then the parents get to treat that $8,000 of taxable scholarships as if they had paid that out of pocket for purposes of claiming education credits. So here's a worksheet that helps you figure the standard deduction for dependents. And you'll notice at the bottom here, this is also on page 223. You'll notice at the bottom here is that you figure the standard deduction based on those rules. Earned income plus 400, but at least 1,250 and never more than 13,850. After you do that, then you add the additional standard deduction for 65 or older or blind. For example, if I wanted to claim my grandmother as a dependent, and she's an Alaska resident, and her only income is the PFD, assuming she qualifies under all the other qualified relative rules, then her standard deduction would be her earned income, which is 0 plus 400. Well, because that's less than 1,250, we clip it into that range, so now it's 1,250. But then she's single, so we add another 1,850 to that. So her standard deduction becomes 3,100. So because her permanent fund dividend is less than 3,100, it's not going to be taxable for her. If I have a dependent who's under 65, part of the PFD is going to be taxable.